Oil prices are edging a bit lower today, breaking below $71 a barrel. One strategist says crude oil could reach triple digits in the first quarter of 2025. Joining us now, Eric Lee, Citi Global Energy Strategist. He made the call in a note this week. And Eric, you guys, like many of your peers, model sort of different scenarios, right? So you model a bullish scenario in which oil could go higher, a base case, what you think is most realistic, and a bear case. But this bull case did get some attention, right? $120 a barrel. You raised the forecast for that bull case from 80, so pretty big increase there. What is driving that, and what has changed in your view to fuel that change?
Yeah, well, it's all the geopolitics. As you mentioned again, we're looking at scenarios. We're looking at a bull case. Our base case remains $74 Brent for average in the fourth quarter of this year. But as we're looking at the situation in the Middle East, and we are being careful not to dismiss out of hand the kind of statements that are coming out of Israel and their intentions. So in that scenario, if there is indeed some direct or knock-on effect where oil infrastructure is hit, there are a number of scenarios where this could impact a couple of million barrels a day of Iran's oil production and exports. And in that case, we could be looking at something more akin to what happened to Russia-Ukraine in 2022. But again, this is a bull case, but our base case remains actually slightly lower or close to where we are right now.
Let me ask you, Eric, let's say Israel does attack Iranians' oil infrastructure, Iran gets knocked off. Do you think Saudi Arabia would step in and fill that gap?
So that's been one big part of what's keeping the base case in the market relatively tepid, right? There's a lot of spare capacity in OPEC Plus, somewhere perhaps around 6 million barrels a day. And demand, of course, has faced issues, notably in China, even though we're waiting to see if there's much fiscal stimulus coming out of that. So if there is a major supply disruption, there is a fairly good chance that, if not impacted, Saudi Arabia, the UAE, Kuwait, and others could return some oil to the market. The issue is, again, whether some of the timing of that and just how much of production is lost. But again, this is a very tricky situation, a very binary market, if you will. And that's why, again, we're being tentative on the upside. It's really the kind of thing that calls for upside, optionality. But again, the base case is actually for prices to drift lower. And next year could see $60. Again, very large range for the possible realization of prices.
Well, and Eric, how do you sort of assign probabilities to those various scenarios, right? And do those probabilities shift over time? So is there a way of quantifying like how likely it is that you'll get that bull case versus the bear case?
It's very tricky. It's very tricky. We need to put it out there as a very plausible possibility. The situation for the geopolitics has always been one that is one of a tail risk, right? So even if the probability is relatively low, it is potentially high impact. And so the first thing was to consider, if we see de-escalatory actions, something more like what happened in April, then we should be able to see prices drift back lower and maybe towards the $70 level. And that's really a case where things are really pulled back. In April, Israel attacked Iran. Iran retaliated in a somewhat careful way. Israel counterattacked in another fairly calibrated way, and this was considered by the market as de-escalatory. This time around, if indeed, the U.S. has been urging Israel not to target nuclear and oil-based infrastructure, if that holds, we could see a similar situation here. But again, the rhetoric continues to be quite fiery, and so we want to be cognizant of the possibility that this may still happen.